Hi, everybody. Thank you so much for joining us today. We have an incredible panel. My name is Grochowiak of Groho Group. This is my brother, Ed. We're both realtors in Chicago, but we're not the most important people on this call. We have some incredible people that are going to be here helping us out today. And we're going to kick off with Mary first. And she'll speak a little bit more to who she is, what she does, and how she makes like the dream of home ownership a possibility. So I'll let you kick it off and kind of explain, who you are and what you do, and just kind of provide value and education as you always do. And I think that this will be really great to get this into a lot of people's hands today.
Awesome. Thank you. Thank you. Yes. So I'll explain pretty much, the lending portion of this. There's agent, lender, attorney, right? And so if you want to start maybe with that first slide, that'll be a great way to kind of segue into this. One of the most common questions that I get asked by people, that want to buy a home is, what does it take? What does it take? What does it take? Right. So, generally it's 4 main qualifying factors, but I'd be lying to you if I said if it was just 4, that would be not completely accurate. So let's see if we want to go maybe to the first one. There we go. Yeah. Okay. So yeah, I can tell you an easy answer. It would be credit, debt ratio, the 4 C's, but there's subcategories, right? So let's go to the second slide, actually. So let's start here, actually. So for the longest time in mortgage lending, the 4 main qualifying factors have been, credit score, of course, capacity, which really means the ability to repay, which, then gets into income and credit obligations and debt ratio. Collateral, so the property, the type of property, the condition, single fam, 4 unit versus more units than that, right? And character, believe it or not, character. Sometimes we'll need explanations of past derogatory events. And so there have been times where how that letter is written or the explanation has a lot to do with the underwriter file. So let's dive into the next slide. And we're really going to dive into credit, right? Because this is where it really all starts. So I want to talk about, some of the credit tips, maybe some things that people don't realize about credit. A lot of times people think that they're going to get points by kind of maxing out their credit cards. And that's not true. You get positive points by showing you have the ability to pay the debts off quickly, cash flow. So you get positive points by showing that you have cash flow, right? That's why you hear that your points drop after you, utilize more than 30% of your revolving debt, right? When you max out debt. Also, it's all automated. So if you're running your credit multiple times in a short span, the automated credit computer is thinking that you're having a hard time getting credit. And so after so many inquiries, it's going to start to, kind of take that down. Generally, when you're shopping for a mortgage, though, people do have a window. So a lot of times people don't want to rip the Band-Aid off because they think that first inquiry is going to drop the score. And that's not true at all, actually. If 10 lenders, 20 lenders run your credit on the same day, we're all getting the same score. So you do have a window with the credit bureaus. But pretty much what you want to make sure you're doing is utilizing not more than 30% of your revolving balances and trying to pay those off almost in full, right? So you're only utilizing what you can actually really, afford to pay off. That's how people get 780 credit. Now, obviously, everyone doesn't have the means to do that, but if you try to stick with that baseline, that is going to get you good credit, credit maybe in the low 700s, but that's the strategy, okay? The other thing that I really want to talk about is 30-day late payments. People do not realize the magnitude of what a 30-day late or a 60-day late or a 90-day late payment is going to do to their score. It has the ability to bring your score down 40, 60, 80 points just on the first late, 30-day late, right? So if you have to float the payment out there because you need a little bit of extra time, make sure that you're getting it there before the 30th day, whether that be the 20th day, the 23rd day, but do not get it there later than 30 days. Because once you do that, the damage is baked in. Your credit score is based on the past trade lines, past payment history. So that 30-day late is going to impact you for a good amount of time in the future. 1 year, 2 years, 3 years. Sometimes people will get a late and then we can't get a conventional approval and they don't understand why. They still have, a qualifying score, but conventional loan systems really take a look at that. So it's kind of baked in. It'll take a lot longer for your scores to go up if you do incur a 30-day late. Same thing with collections, right? A lot of times people will have some collection accounts and then they think that once they pay it, that, oh, hey, everything should be good, right? But that's not the case either. Same thing. Once a collection hits your credit report, the damage is done. It's going to tank that score 40, 50, 60 points. And by paying it, it doesn't go away. It's going to reflect that it went to collections. Same thing when we submit that credit report to the conventional loan systems, it's looking at that recent collection and it's usually not going to give us an approval. So you definitely want to make sure that you're stocking, your credit accounts. If you got credit accounts open, make sure you're stocking them. Make sure that, a small $5, fee gets on your bill that you didn't realize. And so you didn't make a payment or something like that. You definitely want to stock your credit accounts to make sure that you've got full visibility of what's going on. Now, for those people that don't have credit or maybe have bad credit, what you want to do is start reestablishing that credit with a secured credit card. So a secured credit card is kind of like you're depositing funds to that card, and that's what your available credit limit is based off of. So you can go to sites like NerdWallet, Credit Karma, Bankrate, just Google secured credit cards, your zip code, all the sites will come up. There's going to be different criteria, different annual fees, different stuff based on, is it bad credit or is it no credit kind of secured credit card? So that's really the meat and potatoes of, hopefully the foundation of, what it takes to get a good score up there, right? And how you're going to build that. So make sure if you're opening up accounts that you're actually being very frugal with what you're, spending on those accounts so that you can pay it, right? So that's number one thing about credit, maybe some credit myths or misconceptions about how credit really works. If we could go to the next slide, I think there may be a couple of more credit tips there.
Mary, can I ask you a question?
Yeah, please. And please interrupt me because I just ramble. And
yeah, so just a first question, because I had people send them in beforehand. What are some common items that you're seeing that buyers come to you, or they want to buy a home, they come to you and you see it over and over that they may overlook if it's on something that they owe, or if it's like their credit score? What thing do you see is most commonly overlooked?
There could be quite a few. Well, one, it's if people are unaware of them. Medical collections. The doctor's office doesn't pay the bill, right? Or they submit it with the wrong diagnosis code, and then the insurance doesn't pay it. They probably let the doctor's office know. It falls through the cracks, and then no one pays it, and then it goes. So I see that a lot, and that's an unfortunate thing. People, if you are insured, you want to go back to the doctor's office, let them know, hey, I was here, I have insurance, this didn't get paid, you're impacting my credit, show them the report. I have had success in actually having that borrower go back to the doctor's office. They resubmitted the bill and actually got the collection company, which is assigned by the doctor's office, to remove it, right? We had to do that. So if something like that has happened and you were insured, go back to the doctor's office and kind of put the onus on them, so that they can fix that for you. That's one thing. The other thing I see a lot is a lot of times people will co-sign for other debts that are not theirs, okay? And they think, oh, this person pays the bill. Oh, I'm not responsible. A lot of time people sign up for things and mentally they think, oh, that's not my responsibility. But on black and white paper, right, things don't work how maybe one may think they're going to work. So there's very constringent guidelines as to what is required to be able to omit that kind of payment from someone's liabilities, right? So it's along with co-signing for things like automobile loans, right? Some of these programs will want that other person that pays the bill to be a co-signer. And if they're not, we can't omit it, right? So just so you guys know what the magnitude is, I see people have these really high car payments all the time, like $600 a month. And if you were to kind of quantify, what portion of that is their income, it's a good amount. It's probably too much, right? A car payment of $600 a month on a 30-year term at 3% is the equivalent to financing $144,000 in mortgage. Okay, so try to wrap your mind around that. Okay, so if you've got a car note of that amount, a lot of times by the time that we can actually, I may run into someone that's got good credit, but with their liabilities, we can only qualify them for $50,000, right? Because you got your property taxes, your insurance, your mortgage insurance, things like that. So that is why get the house first, not the car. Don't get the car first, get the house first, right? So what we've been doing with some people, and we've been successful, is if they do have those, $600 payments, we've been able to get them to refinance. And that has been helpful. You know what I mean? That has been helpful. So, even $600 payment to $400 payment, right? That's going to help some of your purchasing power, probably by like $50,000 for a $200 payment or something like that. So that is one of the things that I see people just kind of getting into too much debt, beyond their means, or getting the car first, or co-signing. People want to help their family out, and I definitely understand that. But you definitely maybe want to talk to a lender and just really ask how that's going to implicate you before you do that, because we are seeing guidelines tighten up. In fact, there was a new change that we'll talk about maybe later on here about how they're not allowing us to use prorated tax credits anymore for that person's bottom line. So, we have to back it out, and that person has to qualify with sufficient assets of their own before the prorated tax credit comes into effect. This is going to be on all loan programs. Fannie Mae, Freddie Mac rolled it out. These are the AUS systems that we use for FHA as well, right? So this is now going to impact all loan programs. And we used to really actually bank on that prorated tax credit. That could be $4,000, $6,000, you know what I mean? So now that's going to change. As rates get lower, you got more people in the market. The cost of entry, barriers to entry are now increasing. I'm seeing it everywhere on multiple levels. So that's what I would say is one of the biggest things, collections, medical collections, right? Maybe thinking that once a collection is paid off, that your score will go back to 780, and then co-signing for obligations, or having obligations that are just, a little bit beyond, the normal or average kind of payment,
Sure. Okay, great. All right. I will share this again. I think we were right here, right? Yeah. Can you see the
Yes. So this is the derogatory credit wait times, right? So for a lot of homeowners, there's all this stuff out there in the media about real estate investing, and you don't need your own money. And that's, for the most part, if you're the average, American, you're going to be looking at two main programs: conventional and FHA, okay? Unless you're a veteran, those are the go-to programs in the marketplace that offer the best rates and the lowest down payment requirements, right? So that's why we have this right here. Any other loan product is going to be like a private loan. If you're not meeting the qualifications for these types of loans, it's higher risk, which means higher interest rate, higher capital requirements. So really we want to focus on what do we got to do to qualify conventionally, and FHA. So once someone does have a derogatory event, they have wait times in mortgage lending. So if you have a bankruptcy like Chapter 7, right? In the conventional world, you cannot be eligible for a loan until 4 years have passed from the discharge date, okay? And the FHA loan space, it's 2 years after discharge date. And if it's a foreclosure, then you have to wait 7 years in the conventional space, and then a 3 to 4 year wait time in FHA loan space. Generally, it's for, a lot of times people will say, oh, maybe 3 with extenuating circumstances. For the most part, though, you don't see a lot of that. So really, have your mindset on 4, okay? And right here, I've got it listed again, that conventional loans don't like collections or charge-offs. They're very credit sensitive. One little recent late in a 12-month history or 6-month history is all really it takes, so it's going to look at your overall credit history. If you were 800 before that late, yeah, you'll probably get an approval. But if you were 640 before that late, that's not going to go. So the other thing that you should know is that government loans, FHA loans, VA loans generally don't allow for more than 2,000 in charge-off accounts. Lenders have some tricks. We can use 5% of the balance sometimes. And if we do get an automated approval, then we can go that route as well. But again, that's going to kind of bite into your debt ratio, right? Into your available financing if we have to factor in another payment for an account that was charged off. But sometimes we can still make it work. So these are also very important drivers. These are the catalysts of, if people are going to qualify for FHA or conventional, right? This is, really what you need to be looking out for if you did have a past derogatory event. All right. So this is something that also changes. Credit score requirements change time after time just based on what the market's doing, right? So before the COVID crash of last year, we were as low as 580 on VA loans and FHA loans. Conventional is generally 620. You do have some shops that will make exceptions. That's not the norm. So we really just want to focus on what the norm is, which is 620. Right now, FHA and VA financing is at 620. However, literally today, we just got some updates about those scores going back down to 600 for FHA and VA on certain scenarios. So, look out for that because, as long as this market is sustainable and investors are now no longer fearful of, the COVID crash, you're probably going to see those credit scores start to come down again in the VA and FHA.
So would you say then the certainty and just the stability of the market is why you would see the credit score go down and open up to a bigger pool of people? Is that what you're kind of?
Yes. Yep. So the reason why credit scores went up during COVID, right, is because investors were concerned of, massive unemployment, right? They didn't know who was going to be affected, obviously, but obviously banks, the way that banks think is, hey, are these people going to be able to pay the bill? Hey, are you going to be able to pay that mortgage? Well, until we kind of figure out, what's going on because of COVID and job loss, that's why they increased the credit scores, and a lot of private loans, a lot of non-QM programs went away because they were riskier, right? So before lenders feel comfortable lending on big loans at low interest rate in a day where people may or may not have a job, they wanted to see stability first, right? So I think a year later, we're kind of, at that pace, we're seeing stability. There wasn't a housing collapse or a foreclosure boom or nothing like that. In fact, kind of the opposite has happened now. So we're starting to see some loosening there of the credit scores, and hopefully we'll see other programs, come back, but slippery slope.
Right. So, and just a question, what's the down payment that you're seeing most buyers come in at right now? Because I think that there's, kind of some confusion. I think a lot of people think, oh, it's 20%. What are you seeing right now from your end?
Yeah. It's definitely not 20%, guys, right? So, conventional loans have as little as 3% down. FHA loans have as little as 3.5% down, right? Then you've got your down payment assistance programs as well that will give the entire, 3.5%, to the buyer for assistance, right? So there's IDA. Federal Savings Bank also has a down payment assistance program that has higher income limits than IDA, actually. So we're able to help a lot of people that maybe, weren't eligible for their state housing programs with our internal program. But you definitely don't need 20%. Before this recent change on the prorated tax credit, I would tell people, if you have a good job and a good debt ratio, give me 3,000 or 4,000 and I can work with that, right? But now with this change in the prorated tax credit, now we are going to have to at least show that the borrower, has sufficient funds, for cash to close. So, so we may be using, some more down payment assistance programs to do that, because that's what's going to happen. That it's going to force more people to get assistance or get gifts, right? we're not going to be able to utilize that prorated tax credit. But does that answer your question?
Yeah, it does. And I think it speaks to your, like, I think it speaks to your ability to be educated on all these different programs. Cause like you said, like, as today, the market has changed and these requirements are changing. And I think, you really have to, like, this is the difference between working with, someone who's like, you submit your online mortgage, whatever approval, and you get this number back to you. And then a person who's literally reading up, knowing about the programs as they change daily and putting you in the best position, which is like, I again, like, it's like everybody loves looking at the photos on like the Zillow, the apps, the Redfin, but like the most important thing, and I'm hoping people are taking away is like working with someone, and I think Mary too, like at the end, we'd say like, we always like to try to give people like, what is the one big takeaway that you want like someone to learn from like your presentation today? Just keep that in mind, like as we kind of come up with that, because it's like, what is the one piece of homework that you want people to put into practice to get themselves to be in the place to be at the finish line? But like, I think that sometimes we try to do that. Like, what's the one big takeaway that you want them to kind of leave this with?
Yeah.
And kind of put into application and practice.
Yeah, I've got a great takeaway. The takeaway would be, you want me to tell you now or later on?
Why don't you share this now? Yeah.
Okay. The biggest takeaway that people need to, take away from this is knowing how to calculate their debt to income ratio. Okay. Because that can help them manage their bills and their expenses so that they're not shooting themselves in the foot. Right. So let's, simple example, flat numbers. Let's say that you make $4,000 a month, right? Your debt ratio in the conventional world, FHA world, really the rule of thumb is 45 to 50%, right? 45 to 50%. Excellent credit will get 50% on a conventional loan these days, but if you make $4,000, your debt ratio, your max debt load is 50% of that. So that means 2,000. What that 2,000 represents is your max debt load per month, which has to include the new mortgage payment, principal, interest, taxes, and insurance, okay? Plus any other monthly obligations that you're paying per month on credit, right? So what I'll do is I'll kind of reverse engineer it and start backwards and ask people, okay, wait, you make, 4,000, our max debt load's 2,000. What are you paying per month on bills, right? Let's say it's $600 a month. We back out the 600 and then we've got, a $1,400 mortgage, right? Then I'm backing out an estimated cost of homeowners insurance, usually $100 a month. Then we're backing out taxes, at least 400 in Chicago, right? And then we're backing out mortgage insurance, right? That leaves us with a principal and interest payment. And then if you do a 30-year term over a 3% rate, you'll see what you qualify for, right? So by people knowing what their limiting factor is, their limitation on financing, that gives them the power then and the motivation to then start maybe paying off some bills, or hey, they're not going to get that new car. They're going to drive, the hoopty for a little bit until they buy a home, So knowing your limiting factors, right? That is what everyone should take away. So limiting factors are going to be not only debt ratio, but your credit dings, right? How those will impact you. And what you can do to make sure that you aren't getting dinged on your credit at all. Those are the real two main takeaways. If people have that kind of knowledge in their mind, they can maneuver daily, with that goal in mind. Hey, I've got to get rid of $300 a month in credit cards. I got to get rid of these accounts. Hey, I've got to pay off this car. Hey, I've got to refinance this car. Hey, I've got to get rid of $450 a month so that I can qualify for this $300,000, home.
Mm-hmm. That's great. That's right. And like, cause that's an actionable thing that people can actually put into practice.
Thank you, Mary. And there's one more question that I can save till the end, but Don, do you want to kind of jump on and share your thoughts from the legal perspective?
Hey, that was a wonderful talk.
Thanks, Don.
You guys did a great job. Well, listen, I don't want to take away from anybody's thunder, but before I'll make mine quick, but I just want to give everybody a heads up that Meg and Ed, these are two really wonderful professionals to work with. And, in real estate's a very unique business. There's a lot of business that are like, B2C or B2B. Like real estate's crazy. It's like B to C it's like B to A to A to A to C, because you got all these different supply chains integrated into the transaction. And one of the cool things about Ed and Meg is they're constantly monitoring that, making sure that it's going well. I've had a chance to work with both and they're wonderful. Okay, with that said, that's my plug to them. Whenever you do a real estate transaction, there are 3 steps. The first step is due diligence. The second step is financing. The third step is closing. The first step of due diligence is where you get a chance to kick the tires and look under the hood to make sure that you like the place. If you're buying a condo, there's 2 parts to due diligence. The first part is the inspection. The second part is the HOA documents. Whenever you buy a condo, you're buying a percentage of a not-for-profit corporation called an HOA. You want to make sure that you're going to be okay with that, because you're going to be tied to these people for a long time. You want to check out the financials and the rules and regs to make sure that this is the type of place you want to live. Ed and Meg are great at checking that and analyzing the properties. Once we get through step 1, step 2 is the money. Without the money, there's no party, right? So the financing, which was more than thoroughly explained earlier, is something you guys went through. Go listen to the video. It was a wonderful explanation. Once you get your loan ready, you move to the third and final step, which is closing. That's where you show up and I show up, and we make sure everybody delivers what they promised. That's kind of a real estate transaction in a chronological nutshell. If you guys ever have any questions, feel free to reach out to me, but reach out to Ed and Meg if there's anything specific.
Don, our millennials, unfortunately, are always asking about the monies. So like, can you just tell everybody, and I think I forgot to ask Mary this too, but like, how much does it cost me to have an attorney, and like, when do I have to give the money? And like, because I swear, I feel like that gets in the way of people's.
I think people think they have to have you on retainer.
They watch TV shows like Law and Order, and they have no concept of real Law and Order.
Yeah, so real estate closings are not profit centers for most attorneys. They're relatively low margin, flat fees. And for when we do them, we're mostly doing it as a lead generator to create like relationships with the community, right? In theory, the theory is you meet someone for their closing, then you become their family attorney for their will and trust and everything into the future.
Right. So it's like paid at the, like, they don't have to give you money up front, they get paid. When do you get paid? That's what they want to know. Like
at closing. For the most part, it's better to get paid. I generally tell people there's actually a tax reason why it's better to get it rolled into the closing statement. That way our cost gets like added to basis as a closing fee. So you pay us at closing.
Now, Don, there's a lot of killing of deals happening right now. And I think buyers are always saying, hey, if I don't like this place, when I find out what's the condo docs are, or if I have the inspection and the roof needs work, can I kill the deal? Can I get my earnest money back?
If you're still in the due diligence period, most contracts typically have 4 major contingencies. There's attorney review, depending on whether or not you use the CAR or the 7.0, they have different ways of terminating it, but they both do have inspection, HOA, and mortgage. Now, so long as you timely terminate, like if you timely terminate the HOA based off of HOA docs, then sure, you'll get out of it. And so long as you're doing it within that attorney review period, you still have a chance to terminate and get your earnest money back.
And attorney review is 5 days on the CAR contract, but can be extended past that if an extension is needed, correct?
Well, it's 5 days on the 7.0 contract. It's blank in the CAR contract. You got to fill it in. And customarily, it's 5 to 7 days.
And a lot of deals are falling apart right now. Do you see that in terms of buyers worrying about certain things that they get hung up on? Because I think right now I heard some stats, it's like 35% of properties are coming back on the market, at least after it receives 1 contract. So what are some of is it miscommunication between agents?
No, we live in a really unique time. It's kind of a perfect storm. I've been in the real estate game I've been doing law for 15 years, CPA for 19 years, and real estate for longer than that. We live in such a unique time. And that unique time goes like this. There's super low inventory, but there's super high demand for velocity. What's causing the velocity is there's incredible inflation that people are, and real property is it tends to be a hedge against inflation. That's number one. Number two, people are redeploying themselves because all this remote working and there was some turbulence in the city, and everybody's a tough guy who wants to house hack. But when you have kids, it's very difficult to house hack, right? People want big backyards. So all of a sudden you're seeing people forced into redeployment of their brick and mortar. And it's caused this incredible surge of demand, right? I recall when, 5 years ago when I was, me and my team, we do a lot of real estate investing. And when we were trying to ID properties in the North Shore, you couldn't give these things away. Now, once the turbulence began in Chicago, there's no vacancies anywhere. So I think what you're seeing a lot right now is you're seeing buyers becoming picky because the purchase price has been pushed up. The reason why the purchase price has been pushed up is the interest rate is arbitrarily low. Some of this velocity from a macro level is being caused by, the sugar rush of the interest rate. The interest rate is, debatably unnaturally low, right?
Yeah.
That's pushed up all these purchase prices, right? So you got these buyers who are nervous that they're going in and overpaying. So they want to make sure that the asset that they purchase is correct. Sellers, on the other hand, listen, real estate is cyclical. It goes up and it goes down. We've been on like a 12-year bull run, which is crazy. So I generally tell people, I think we're in the bottom of the eighth of the doubleheader. And I think sellers are trying to, if they're not hunkered down for a long time, they're trying to, maximize dollars right now. So all of a sudden it's causing two different people. One side wants to maximize, one side is trying to hedge risk. And when you put that two together, it's just a perfect storm for, yeah.
That's a really great explanation of that. Thank you for going through that.
Major takeaway, Don, for someone who's buying their first home?
Listen, I always tell people, before I was a lawyer as a CPA, I tell people never let the taxes wag the dog, right? When you're buying a place right now, it is an incredibly sensitive time. If you really want this place, right? And this is, we're talking for principal residents. If you're doing investments, stick to the numbers, right? But if you're buying something that you're going to actually live there, don't penny pinch if you're going to want to live there. Don't be, penny wise and pound foolish. Find the right asset that works for you. And if that means that the market is charging you a little bit more money, then it is what it is, right? It's like buying a stock on E-Trade, right? Just because Apple was one price one day doesn't mean it's going to be a different price the next day. Same principle works in real estate.
Got it. Nice. Thanks, Don.
Thank you.
Hey guys. Hey everybody. I really appreciate you guys letting me be part of this. My two daughters are going to kill me if I don't take them to the park. So I have to bail. Okay.
Better have a fun time with them, Don. Take care.
Thanks, Don.
I appreciate you guys. Bye-bye.
Take care. So we are just going to wrap it up with just a few insights into the market that we're seeing right now. And like Don said, low inventory.
And Mary was speaking to the low interest rates. And although there's about 1,300 new properties that came onto the market, we see the desires have changed. And I mean, I'm sure Mary could speak to this too with a round of single home applications that she's, gotten interest for. That was something that people didn't talk about a year ago, but the desire for that single family home is so great in Chicago. And also that competitive price point, it really ranges from as low as 250,000 up to 750,000, which is, it feels like it's a large range, but for many different people, if people are first-time home buyers, if they're moving up, that's kind of where we see it's super uber competitive. And those properties, if they are turnkey and they're priced correctly, they are flying off the market.
It's a great point what Megan's saying, because if anything's priced well right now, it goes within about a week. And that's because we see right now buyers looking for these three items, especially after COVID. And during COVID, but the location, a large backyard and a garage. Location has always been extremely important, but any type of outdoor space is what people are craving because we have been shut up in our houses for a number of months now. And then I think as well, we see this in the city a lot, people wanting a garage. They don't want to have to shovel themselves out in the middle of the winter.
Especially after a bad winter. I think that desire goes up too. But so we're here really about education, and we found this buyer tip takeaway that we want you to think about. It's I think when you talk about people that are maybe closer to my age, mid-30s, have never purchased before, your expectations are completely unrealistic. It's like we have people who are at Target and they're literally scanning on their phone to see if it's cheaper to buy on Amazon. All that stuff aside, you have to prioritize your wish list. What are your non-negotiables, the things that you need to have in this home, things about like, oh, this is a nice add-on. Maybe for you, like having a garage that's, like has a drive up is a nice add-on, but it's not a desired, like a lot of people that we have looking in the suburbs, they're like, it has to be a connected garage, but like sometimes it's not, and also your dream items, your pie in the sky is like, thinking about it, having a pool, having a sauna, having a wine cellar, like, yeah, you'd love to have it. So would everybody else. And if you do want it, the price is going to be higher. So think about the 80-20 rule. Does this property have 80% of what you want? If it has close to 80% you want, stop thinking that there's something better out there, because this might be the right house for you. So that's important to prioritize.
And this is something that we'll talk about on the last slide as well. But a lot of times people are saying, oh, I want to spend $300,000 instead of just really rate proofing their budget. And what does rate proof mean? How much do you feel comfortable paying per month? If it's $2,000 a month, if it's $1,200, if it's $2,500, to figure out what you can afford, and then to use that as a price range. Because really, right now, when we see prices rising, it doesn't so much matter what a buyer wants to pay for it. It's much more, what does a seller want for it? And to really look at, and that's why Mary would be great to look at different properties and say, this is what you're going to pay per month, to get a very realistic view of what that liability would be in terms of your cost. And we're just talking to a few of our buyers as they look back at their first time home buying experience, regarding money and how much to put down, is what Aaron said. A lot of people, like we were talking about earlier, think that they have to put down 20%, when the majority of buyers right now we're seeing is putting around 5 to 10%. I see 10% as a kind of a sweet spot right now, but we see, people at 3.5, 4, 5% as well. And then again, to, not to get caught up in the sales price, really rate proof what you're looking for in terms of, I feel comfortable spending X per month, and amenities and necessities, like we talked about, location.
If you need that backyard for the dogs or for the kids or for yourself and your own mental health, then you should not be looking at a condo that does not have a backyard. Period. Exactly. End of story. Even if it's the same price point. I think that this is really important. I think because people have been on this slow drip of looking at real estate for over a year, when you actually get into the driver's seat, you've spoken with someone like Mary, they've set you up with a pre-approval, things go really fast in the relationship between the mortgage lender and the retailer, regardless of the day of the week, regardless of the time of night, is so key. Because if you go in to see a property, Mary's going to be that person that if we walk out of it and we say, Mary, this is the one, Mary's going to update the pre-approval letter and she's going to answer a phone. You get what you pay for when it comes to services. Like, you want to make sure that that mortgage lender is willing to communicate with you and your lender, and they're working for you. And if they aren't, you're going to maybe miss out. The last one also, I think, is important because, Mary was speaking to it. Eddie, you can close it out.
Yeah. So, earnest money right now, we see earnest money varying, but, in a competitive market, a lot of times people are having to put down $2,000, $2,500 initially, and then $2,500 additionally after attorney review. One thing we want people to take away is to remember that your earnest money begins your down payment. So you get credit for that at the closing table. So again, your earnest money is your good faith offer
that you're not going to flake out,
and that you're going to put your money where your mouth is, essentially. But if you need to kill the deal during the inspection, then you can get that earnest money back. If you decide to go forward with that property after the inspection, that earnest money will begin the down payment for you. An inspection is ranging anywhere between $250 for a condo, upwards to about $400 for a single family home. If it's a multi-unit, you're looking at around $600 or $700. And with that, you get a full inspection report with photos and details about all the things wrong with the place. And this is just a great way to pull back in, Mary, because people freak out the night before their closings because they say, I haven't gotten the final wire number. How am I supposed to wire it? Because I'm seeing this, I'm sure you are. Are everyone's numbers coming in the night before? Because everybody's kind of tight right now.
Yeah, it all goes back to supply and demand, right? So there's so many transactions, right, that there's a long line. And so we try to, every lender tries to do their best to accommodate a fast closing. We try to do same days, or same days or next days. But if we're doing a same day or a next day, right, that bottom line, we're going to get the final bottom line, like, at the 11th hour. So what we try to do is we try to give the borrower a projection, an amount that's going to be maybe a little over what they're looking for or what they're going to have to bring. And then the title company is going to just cut them a check back, at closing. But yes, that to explain, that's what's going on. It's just there's so many transactions. If someone wanted final figures the day before, that closing time frame would have to be like, 72 hours, or 96 hours in advance or 98 hours or something like that.
So Mary, can you you've done such a great job. Can you just speak a little bit to how can people get in touch with you? I know that you're a new flagship office and, just let us know, because I know people are interested because really there's no house without you. So it's so true.
Yeah. So, Federal Savings Bank just moved to the Fields building here at the University of Pulaski. It's all new, really nice. It's nice tile. I mean, it's very big and very posh. So you can always just come right on in, right? You can also, you can email me. So people can find me on Google. If you Google me, Mary Cazares, the Federal Savings Bank, my banker page comes up. All my contact information is there. I even list my cell phone. I always, try to be available. Obviously, some things may pop up, but I'll get back to people right away. They can text me, they can email me, Google me. My handle is the Mortgage Daddy or Mortgage Daddy on Instagram, MTGDADDI, So, there's so many ways to, text me, 773-440-3434, but just Google me and all my info will come up there, including our online application.
Awesome.
This is absolutely incredible.
Thank you for joining us, Mary.
Thank you guys. Thanks for having me. I appreciate you.
Sure.
And I just want to say shout out to, Mary, just because the services that you provide are beyond what your typical mortgage broker does. And I think that
and thank you for doing that. I don't want to plug you, and I'm not going to say her name because she's going to watch the recording, but she's one of our common clients who's been working with Mary for the last about 3 weeks and said that no one has been able to ever offer her the level of service in terms of helping her understand the process as a first-time home buyer. And, again, that's what is critical for success in this market, to work with somebody who cares. And, big shout out to the person who I know is going to be, because she was like, please send me the recording. But
making it happen and really making it happen, even when there are challenges and there's hurdles, and helping people create plans and making home ownership accessible for whoever wants to do it and whoever wants to get there, and helping them get to the finish line. And we're just excited to have you guys at this one. Hopefully we'll be having one of these in person in a safe social distance way, maybe at a brewery or a coffee shop sometime soon. This is absolutely fantastic, Mary. Thank you so much for everything you did. And if people wanted to get, in touch with you and get the slides, could they do that as well?
Totally. Listen, I am all about disseminating this on a massive scale because, it's been a thought of mine that we need to get this kind of content out to people.
Yes.
Because this is where people that have interest kind of, hit the stumbling blocks, right? Yes. There's so much information out there and people try to do their diligence and try to read up on it. But sometimes what you read is not how things are actually working in real life application, and same thing with guidelines. They're always changing, credit scores, things are always changing so fast that usually the people that are writing the articles, they're not real time, keeping up with this stuff, right? So please send the slides, send the recording, hashtag it everywhere. First home buyer groups, do it everywhere, because I want this information to get to people so that then they have the baseline, the foundation of the knowledge, and then that can just help expedite their journey, right? But yeah, no, I'm all about it.
Oh, that's
Great.
incredible. Thank you, Mary.
Thanks,
Thank you for all
Mary.
your time and dedication today.
Absolutely. Thank you guys. Thank you guys so much for having me. I can't wait to the next one.
Thank you. This is
Bye-bye.
awesome.